All right, good evening, everyone. What's going on here? Everyone is online. I hardly, there are only two people here in the classroom. What's going on? Are you guys there? Hello?
Hi, Professor. I'll be there on
Oh, hi,
on
Candice.
Monday.
What's happening with the volume? It's my volume?
Hi, Professor.
Hi, how are you, Awa? How are you?
Good
How are you,
evening,
Yvonne?
Professor. I
I'm
have
fine.
PC4. I have to get the test.
Hi. Yeah, I can see a couple, some people cannot be present in person, but looks like um, a lot of people have already signed into today's forum. But alrighty, at least you're attending, and two people here in person. Maybe you better completely convert to online. Um, Maybe next time. So let me quickly check. All right, am I? I'm sharing. Let's see if I'm sharing my screen. All right. Let me share my screen. All right. Share, all right. I see 10 people. I see 10 people here attending in the collaborate session, and I see. I see 12 people. So it's just uh, just one person still missing. Just a discrepancy of one person. All righty. So I think we have too much light. So this is 24. All right. All right. So uh, we're gonna continue from where we left off last time, and which is the uh, market value based capital structure, right? Developing market value based capital structure. So I'm just reiterating what we did last time, right? Um, so our example, the Wachusett Corporation has the following capital situation. Three capital components, right? Debt, preferred stock, and common stock. Equity being the common stock, right? Okay. Common. So, okay. Um, so this company issued 20,000 bonds 5 years ago at the coupon rate of 12%. Okay. Um, they had 30-year terms. That means, that was 5 years ago. So that means we have 25 years left, 25 years to maturity. They are now selling to yield 10%. And I said last time, I told you, that's the way it is worded. That just means, uh, okay. they never say straightforward, they never say, uh, use this, right? Use X% as discount rate. They never say this. Instead, how it is worded is, the bond is priced to yield X%, or the bond is selling to yield X%. Basically, that's the same thing. Or another way of saying that is, similar bonds or comparable bonds yield X%, or pay X%, yield or pay X%. The third way of wording is that the prevailing market rate is X%. Something like that, right? So those are the way it is worded, right? To mean, discount rate. Okay. So from this we get the Q. The Q is that this 10% is the discount rate. We need to use this 10% as the discount rate. The preferred stock. They sold 4,000 shares of preferred stock, and 4,000 shares are outstanding, each of which pays an annual dividend of 7.5. And I talked about this last time. Preferred stock is perpetuity, because preferred stock pays constant dividend forever, right? Yes. Stocks are basically, stock going for. Yes, Elizabeth.
So what's the difference between preferred and RUS? You think resident? The
What's-
RUS stock. What's the difference between
RES?
RSU? Is it residual?
RSU. I don't, never heard of it.
I'm gonna look it.
RSU. Yeah.
They are restricted. What's the difference between restricted stock unit and just like, is the dividend the same or no?
I don't know. Honestly, I don't know. Never heard of, RSU, but let's see. I mean, preferred stock is not restricted. I mean, you can trade preferred stocks, but they are rarely traded. Okay? Because preferred stocks, I mean, if I have preferred stocks, I can trade it, but the transactions are relatively rare compared to what I'm saying is it's really rare. I mean, compared to trading of the common stocks, it's relatively rare because price doesn't change that easily on the preferred stock. So preferred stock is held mainly for tax shield, tax purpose, right? And usually individual investors don't hold preferred stocks, usually. It's mostly institutional investors that hold preferred stocks. And the reason is, if a company holds preferred stock of another company, right, they are 70% of the dividends received is tax exempt. Only they pay 30%. They pay taxes on only 30% of the dividends they receive from another company. So this is one way the corporate America gets more sound in terms of its capital structure, right? Because think about it. If instead of if it is only equity, common stock, and debt, then the companies that are debt financing, instead of debt financing, if you debt finance, right? If the capital structure is, let's say, 50-50, right? Debt and equity, 50-50, right? Instead of 50% debt financing, right? Because if you're debt financing, you will have to pay interest on it. Interest is a constant amount, always. Isn't that right? Interest is a constant cash flow. But if you have to finance it by debt capital, which pays out constant interest, what would be the difference if we finance it with preferred stock? Because preferred stock is not debt, so there is no concern, there is no risk of default, right? And it pays, a constant dividend, which is like debt. So that way, instead of 50% debt financing, let's say you finance 25% preferred stock and 25% by debt, the capital structure of this company becomes much more sounder, much more sound, right? You understand? Because financial distress will go down drastically. I mean, at least your default risk goes down significantly, right? But let's see what RSU is. I'm not sure what. It's possible. I mean, some stocks are there's Class A, Class B. State University, restricted stock. Just let's find what definition is. Maybe they will, since we don't have much time, let's try this.
In year 19 trials, they must be using all of these tools, remote monitoring management.
Many employers who hope to attract and keep the best employees use restricted stock units, RSUs, as an enticement. RSUs are compensation in the form of stocks that an employer pays an employee according to a vesting schedule. RSUs are a flexible form of tax-deferred stock compensation that does not dilute a company's shares. Okay, so since we don't have much time, right? You can just read it up or play that video later. It looks like it's something like a employee ownership. In a way, the company is giving like stock options to the employees, right?
Yeah, I was asking because when I left work, there was a meeting I was supposed to be on, but I had to come to class.
Talking about,
And they're giving us those stocks as
it's like
our bonus, but I wanted to know more about it. I thought you would have knew, but thank you.
Yeah, it looks like a stock option, sort of like stock option program. And it used to be called, employee ownership in the past, because stock option is usually offered to the management, right? Top management, usually, to attract management. But also, employee ownership was, one way they usually back in the 1980s and 90s, companies offered stocks to their employees. That way, the company's capital structure gets sounder, right? And then employees will have stake in the company's profit, right? So that promotes hard working, company. If your stock value is tied to the company's performance, you would work harder, because if you work harder, company's profit goes up, your stock value will go up, right? You can cash it out, of course, right? That's one. Instead of cash bonus, the company wants to save. Most likely, the company wants to save the cash flow, right? Instead of paying out cash bonus, they pay stock options, stocks, and then when it's sort of, in a way, win-wins. It's a win-win game. Company saves on the cash flow. The employees will have stake in the company, and the employee, they can also cash out, they sell, right? And employees work harder to increase profit of the company, right? Which will translate into higher stock value, right? And higher, which will also translate into their higher wealth,
Right.
right? But you know, if you want, you can cash it out. If you want, instead of cash bonus, you can, right? So it looks like, you know, that kind of stock option thing. All righty. And where was I?
Preferred stock.
Yeah. So, and I said, you know, preferred stock is a perpetuity, and it pays. How we value perpetuity, you know, from how do we, you know, that's why we talked about the valuation formula last time. There are, in stock valuation, there are 4 stock valuation formulas, and perpetuity is zero growth model. So we use, you know, this is the formula, right? So for preferred stock, it says dividend was what? $7.50. And the, this says one thing about it. And then yield, currently 13%. Whatever they said, I mean, originally sold to yields 15%. We verified it. If you dividend divided by this, right? At time zero, dividend, $7.50 dividend divided by 15%, yeah, would result in $50 face value. We verified it last time. Now they are selling to yield 13%. That means the where? So I think I will have to do this. So you divide that by 13%, then it should give you the stock, you know, stock price. And again, this is preferred stock price today, right? So whatever it may be, we can get it, right? And then finally, common stock. What about the common stock? Oh, okay, I can do this. No? Okay. What about the common stock? Common stock price is, we are doing the market valuation, right? We're doing using the market value. So we just take the market price of the stock. And the market price is $15, and how many shares are outstanding? 200,000 shares outstanding. 200,000, right? Again, this is based on the assumption. I explained this last time. Intrinsic value is what, you know, intrinsic value is the rational price, right? But again, market price is not a rational price in the short run, right? But in an ideal universe, market price would be equal if the market is really efficient. Market is strong. There are 3 perfectly efficient, and there are actually, you know, in terms of, you know, efficiency, there are 3 types of efficiency. One is strong form efficient. Second, semi-strong form efficient, and 3, weak form efficient. What does that mean? If the market is strong form efficient, that means every possible information that is available, publicly or privately, is all already priced into the price of the stock, It's already priced in. So that's what is meant by strong efficiency, strong form efficiency, right? So if that is the case, I mean, in an ideal universe, yeah, market will be strong form efficient, and market price will be exactly the rational price. That should be, that's why it should be equal to the intrinsic value. So we are all assuming such an ideal universe here, right? That the market is strong form efficient. But the reality is not, right? We all know in reality, market is most of the time semi-strong form efficient. Semi-strong form efficient. That means, not all the not all the private information, not all the public information available there are not exactly priced into the. Maybe all the public information is priced in, but private information is not priced into. That's why there is always, there are some people with privileged information, right? And that's why it is called privileged information. I mean, if the public all knows it, it's no longer privileged information, isn't it right? So that's what semi-strong form efficiency means. All public information available, public information is priced in, but private information is not. Now, weak form efficient means, neither private information nor all of the public information are all priced in, right? Then that's weak form efficient. The reality is, somewhere between semi-strong form and weak form. But anyway, so the market price of $15, they assume that the market price is equal to the intrinsic value. So let's develop what you said's market value-based capital structure. And to do that, we go to this Excel file, right? Open this. Open it. You have downloaded it. If you are with your computer, you have downloaded this already last time. And go to the bottom tab, weighted average cost of capital and marginal cost of capital. All right. Go to that bottom tab and go to example 13.2. Example 13.2. So if you go to row 17, it's exactly our example. It's exactly our example. Why? Bonds, okay? What was the bond like? What was the bond? 30-year, it's got 25 years left. Coupon rate of 12%. Coupon rate of 12%. So if the coupon is 12%, semi-annually is $60. Isn't that right? Coupon payment is $60 semi-annually. I mean, that was already here. How did I get $60? I already entered $60 there, but yes.
So just to be clear, when you say coupon payment, right, do you mean the interest that is building on that bond?
Yes.
Okay.
But it's semi-annual, so in other words, I can do this by, okay, let's, face value 1,000, right, times, coupon rate, I didn't put it here, so that's fine. I mean, if coupon rate is not there, that's fine. But let me do this instead. I'll just insert first. here. I'll highlight those cells and insert, and then a new column is inserted. And then oops, not from there, maybe from here. I'll just change that to IC, meaning coupon interest rate. Coupon interest rate. Okay. And 0.12. So 12%. Then you know how we got 60 here, because face value of 1,000 times 12% coupon rate divided by M, twice a year. So each time, every 6 months, right, semi-annually is $60. Now that will make it then now we know that bond valuation formula. We already know bond valuation formula, right? Which is you should be familiar with bond valuation formula already. It's basically a payment over first of all present value of annuities, right? So let me present value of annuities plus the present value of the face value, right? So present value of annuities as payment too long. Payment over R minus payment over R times 1 plus R raised to N plus the face value discounted to present, right? So everyone understands that this is the present value of annuities, right? And this is this, and this is this. So, right? That's what it is here, right? Row 17 is basically present value of annuities. Row 19 is the present value of that $1,000. So what you need to do is, what's the payment here? This is the payment, right? $60. That's the payment over R, 5%, right? Makes sense, because yield to maturity is 10%, right? That's annual. So we have to, discount rate has to be semi-annual because, right? The bond is on a semi-annual cycle. And then minus, again, coupon payment over open parenthesis R times 1 plus R raised to N close parenthesis. There you go. So the present value of all those coupons, that's 1,095. Now the present value of that face value is just 1,000. 1 plus 5%, right? Raised to N. Now you understand why N is 50 and why they were all, because it's 25 years. Time left is 25 years, right? And it's semi-annual. So 25.5, right? And these were already, calculated. It's not, initial data, right? There you go, right? So the present value of the $1,000 is 87.2. Then the price of the bond is this plus this, right? That's the price of the bond, right? And then think about it. How many bonds are there outstanding? 2,000. Then the market value of the bond will be this times, it's not a difficult thing, this times this, right? That's the market value of the bond, right? Now, preferred stock, right? So maybe it should be better. I mean, if I'll do that later. But you know, this is preferred stock. It pays $7.5 dollar dividends. Currently, it is selling to yield 13%. So price of the preferred stock would be, and as I said, you know, it's a constant dividend model or zero growth model. It's a perpetuity, so you apply that formula. There you go. And there are 4,000. There are 4,000 of them, right? There are 4,000 of them. So all you need to do is simply this multiplied by 4,000. There you go. That's the market value of the preferred stock. And then what about the common stock? They already gave us the market price of the common stock, which was what? $15, right? $15, which was already given, right? So we'll just enter 15 there. How many shares are there outstanding? 200,000. All you need to do is simply multiply this by this, hit enter. Okay. So $3 million, that's the market value of the preferred stock. Now, then, you know, sum of all of these, that's the total asset, right? Market value of the total asset. So we'll sum all of these. This is the total asset value, right? I mean, total capital, rather than total asset. Then the weight, of course, then the weight is this divided by this, right? And I'm going to lock it because, you know, normally I will copy and paste, but I won't do that here because this is like three rows, 3 cells merged. If I copy it here, formula gets copied, but then, you know, it will, like, you know, take up like 3 cells. So I'll just divide that by this. Okay. And then I'll copy this and paste here. All right, and if you sum, that should be 100%, right? If you sum all of this, it should be 100%, right? Okay, so did you guys get this? Okay, Elizabeth, okay, good. So this is the problem. This example only takes us only to this point, not more than this point, not farther than, of course, you know, later there will be a bigger example, but right now, they're just, you know, asking us to find the capital structure, market value-based capital structure. So market value-based capital structure is 42.27% debt, 4.12% preferred stock, and 53.61% common stock. Okay, yeah, question?
Basically, you put in any information there to give you, you find out how much the bonds is worth, not the interest. Then you times it by the information they give you to find the B, and the.
This is actually, yeah, bond price.
Right, and then you times it by the outstanding to get the market value, and
Yes.
then you're doing the 5% KB for the 12 to get the weight.
Yeah. You
Okay.
have to divide this by the total,
Uh-huh,
right? Then, that will give you its weight or proportion, right? The
my
weight,
question is, to be sure, the 5% that you have up for KB, right? You got that from the note.
no. It's this divided by two. Yeah.
Okay, good.
Because this was given, right? Yield, it's a problem set. The bond is priced to yield 10%,
Right,
right? Bond is selling, to yield 10%. So that is the discount rate. And then because bond is on a semi-annual cycle, you have to, because it's every 6 months, right? You have to adjust it to reflect, that semi-annual, right? So it's, half your rate. Actually, when we say cost of debt, that would mean, usually yield, but I just use that label here for half your rate because that's what is used to calculate the bond price. So here, actually, I want to, just to make it more clear, I want to insert a row, and then say bond here, and then maybe origin center. This is bond, and this is preferred stock. Red text. Okay. That looks better. And then common stock. Okay, so that would make it, easier to see. So this is that example, 13.2. So so if you got this right, I want, let me make sure that, all righty, so the people the people in the Collaborate, did you guys get this right? Did you get this right? Anyone? Awa, are you there?
Yes, Professor.
Professor,
Did you get it
yes.
right?
Yes.
Okay, Candice, did you too? Okay, Devin,
Yes, I
great,
found
great. All righty. Ibani,
Yes,
Ebony, yeah,
yes,
got it right? Ebony, that's the Bani, Ebony, right? Ebony Hassan, are you there? Jared Epstein, did you get it right?
I'm here.
Okay,
Yeah.
good. All righty, good. Serena, you got it right? Okay, great. Tanvir Hassan,
Yes.
Tanvir, did you get it right? Jimena, did you get it right?
Yes,
Jimena?
Professor.
Okay, all right, good. All right, so people are paying attention. All righty, so next. So this is basically, what we have already done, same result, right? Same result. Yeah, Elizabeth, your question?
just before, because I have a midterm today, so I'm to my other class. Every other example in here, like for example, real options and real options 2, Those are coming directly from this right here, right?
What?
In the Excel, you have multiple like.
Yeah.
examples. It's coming directly from here, right?
No, what as far as, cost of capital is concerned, this
Yeah.
is the only, worksheet with the, examples on, cost of capital.
Okay,
Real options, that's the next topic.
okay.
Real
thank you.
options, that's the next topic, right? That's the next topic.
Is
And
that
these
gonna
are,
be talking about profitability?
what?
Is it gonna be talking about profitability?
Everything has to do with profitability, right?
Yes.
The profitability actually if you want specifically the profitability, we already discussed it in the second topic, right? When we talked about, or was it third topic? When we talked about ratio variables, right? There's a profitability category which, are represented by ROA, ROE, ROS, right?
Right.
And those are direct measures of, profitability, the ratios that are about profitability. But think about it, all finance is basically about profitability, right? Return, basically return is the profit divided by the input, right? Return is basically profit divided by the initial investment, the input that went into, generate that profit, right? That ratio is basically the ratio that measures profitability, right? And that's return. Return is basically profit. Return is basically profit expressed in that ratio of output to input, right? Isn't that right? That's what return is. So the next, so they all calculating now. Next, calculating component cost of capital. Calculating component cost of capital. So in other words, what that means is, although these capital components are originally given, sometimes we need to find it. It's not given. I mean, think about it. In a real situation, who are you going to ask? Who are you going to ask? Where would you go to look up, these? This is something that you have to calculate. If you are if you are an analyst, right? You need to calculate. Of course, there are paid sources like Morningstar and Value Line. They are paid sources. You have to pay, right? But then they are relatively trustworthy sources, but it doesn't necessarily guarantee that they are always 100% correct, right? And it's built on a lot of assumptions. I mean, these calculations are built on a lot of assumptions, and if any of their assumptions are not correct, then but most of the times, Value Line and Morningstar, they have been around for a very long time. They are trusted. But then, why spend money? I mean, you can do this. I mean, that's the reason you are learning finance. You can calculate, and once again, cost of debt is usually the average return of the bond of that particular risk class, right? If your bond is double A class, right? Double A class. Of course, you have to do some research. What are the double A bonds pay you, right? In on average. What do the AA bonds pay you on average? So you take the average of all their returns, and that's the yield for your bond. So that's cost of debt, cost of preferred stock. Obviously, cost of preferred stock is a good measure is we already know when we calculate when we calculate the price of the preferred stock, this is the formula, right? And if this is how you find this, because this is the unknown. But then how do you find this? When this is the unknown, what do you do? If this is the unknown, what do you do? You'll simply divide this by the market price, right? In other words, the market price, let's say. Oh, I'm sorry. What am I doing? Dividend, right? So this way you can, find it. And cost of equity. There are three ways to, but most commonly used and most reliable method is using CAPM. Okay, but it's not only this. In our examples, they are usually given, but then when they are given, there is some considerations that you have to make. For example, for bonds, there's a tax shield on the bond. The interest you pay on the bond, right? So in other words, everyone understands that the so I should bring it down here. We all know if you go back to the financial statements, revenue, investment income, right? From this, we'll have to subtract CGS and operating expenses. We'll have to subtract this, right? And then we arrive at EBIT. And then we subtract interest from EBIT, and then we arrive at EBT. Now, think about it. EBT is basically, EBIT minus interest. So your taxable income is basically helped. Your taxable income is helped by interest. Isn't that right? Yeah. Your taxable income is helped by interest. So that means that it reduces the taxable income. So think about it. You subtract taxes from here. from EBT. So actually, by as much as interest, your tax is going to go down, right? In other words, not by not by that physical amount, but by that percentage. In other words, what is EBT? Another way of, it's EBIT minus interest. Now, one minus tax rate. Actually, okay. What I'm trying to do is, this is EAT. And this is EAT, right? So if you think about it, you're not really paying, even if the corporate tax rate is, let's say, 35%, you're not really paying 35%, right? You are getting helped by the, and the interest is what? It's the result of and interest is EBIT times, I'm sorry, not EBIT times, but interest is debt times KD. Isn't that right? Interest is debt times KD, cost of debt, right? But the cost of debt is, if this is 10%, you won't be paying really. What am I trying to say? I just, the words escape me, but you will see what I'm talking about as we go along. So we need to make adjustments for the tax effects and the transaction costs to arrive at cost of the issuing fund, to arrive at the cost of the issuing. So tax adjustment applies only to debt, right? Tax adjustment. Where is? Because interest is tax deductible to the paying firm, right? Cost of debt is adjusted for tax. In other words, because you benefit in tax from the interest, right? Because that's what is meant by tax deductible. When they say interest is tax deductible, you're not, that means exactly this much is not going to be taxed, right? This much is not going to be taxed. Yeah? Only after this interest. That's why, because it is still business expense. Isn't that right? You got the loan, right, for your business, right, to fund your projects. So interest you're paying on the loan is the business expense to service your debt, right? So that much, I mean, you're not profiting from the, you're not benefiting from the interest, right? Interest payment. So it's an expense. That's why you're subtracting it before taxes so that the tax would go down by as much. So the tax shield is reflected in the interest. It must be reflected in the interest. The tax shield effect, right? The shield effect is, So cost of debt adjusted for tax, right? So it's cost of debt times 1 minus tax rate, right? That's how the cost of debt must be adjusted, right? How it is adjusted to. So then think about it. Debt is made even cheaper by tax adjustment. That's why it is called tax shield. Right? Tax shield. And then what about the stocks? Flotation costs are a percentage of securities price. Fraction, F stat. So flotation cost. What is flotation cost? When you sell new stocks, if only you sell new stocks. If you don't sell new stocks, no. But if you sell new stocks, you have to make public announcement. And where is it done? It's either on TV or on newspapers, right? Or on the internet. You have to pay, right? And then you have to print the new stock, right? Printing and flotation, printing, and transaction cost, right? All of these. That is some percentage of the securities. It will have to be reflected in the securities price, right? So if you're selling new preferred stocks, apply to preferred and new sale of common stock, and it increases effective cost, right? Because think about it. The cost of preferred stock and cost of equity will become greater if you subtract this fraction from 1. You divide this by something less than 1, the whole fraction will be bigger than before, right? So mathematically, that's why how the cost is reflected in the price. So this is the idea behind it. Actually, making adjustment, that we can't do it today. We have about 10 minutes, technically 10 minutes left, but since everybody's online, only one person here remaining, so I think this is a good time to actually call it a night here, right? It's the right point. Any questions so far? Any questions? Okay. How about everyone online? Any questions so far? Any questions?
No questions.
No.
Okay, all righty. All right, then let's call it a day. And I will see you guys next Monday, okay? Hopefully I will see more people in class. All right, I'll stop recording and sign out. Have a great evening, everyone.
Thank you,
Professor,
All right,
thank
you're
you,
welcome.
Professor.
All right, take care
Professor,
now.
I just have this is not a question for class. This is just
Huh?
for
Hold on. All right.